Well, welcome everyone. I feel like a professor here. I'm keeping attendance. I've got a little sheet here, and I think the majority of those who are going to join us, and I'm one who likes to start on time for those who show up on time. So thank you for those who got here early. You've been hearing Phil and I chat a little bit about our stories, our background, and we're excited to really share with you today Phil's / SIA's perspective on the economy, where we are as we round the corner here, heading into Q4, end of the year, an election. There's certainly a lot of things on everyone's mind at this moment. And so we're certainly excited to have Phil, who's a director of investment strategy within the Department of Investment Management at SIA, join us. And I can certainly read a portion of Phil's dossier for you, and because I think it is some relevance. But I think the key thing here for me that was exciting me for Phil is that Darren McCoy often would join us for these events for those who have been coming for a while, and Darren had been with SIA for a long time. But one of the things I think Phil brings a great value in is his previous experience as chief investment strategist at Steel Peak Wealth, responsible there for over $2 billion in assets under his oversight. And before that, he spent time in roles in Morgan Stanley Wealth Management. So this is a gentleman who has a really broad perspective and has had certainly his fingers in a lot of different pies when it comes to the economy, wealth, and asset management. So he brings a diverse perspective and a long history in understanding and evaluating where we are economically, and brings that wisdom to an already well-established team within SEIA. So Phil, again, thank you so much for investing your time with us. Looking forward to hearing your perspective. As a reminder, just a couple things on housekeeping. The messenger is open inside the chat. So if you have a question throughout any of this dialogue, just drop into the chat. I'll read that. I've already familiarized myself with Phil's presentation, so I'll bring those questions to Phil, when appropriate. If it doesn't fit within his presentation, then I'll hold that question at the end, but I will see it. So just drop it in the chat. I'll take a look at it. And without anything else, Phil, I look forward to hearing from you and hearing your perspective on where we are today.
Yeah, thank you very much. And thank you everybody for taking a little bit of time out of your day. Let me share my screen here and we'll get the screen sharing is not turned on. Okay, I think that's something you got to activate. Sorry.
Oh, I apologize. I know what I need to do. I'm making you the host. In the interim, while that happens, if you're curious, that is my 5-year-old playing t-ball. So if you want to smile for today as that loads up, she always gets excited when she sees Daddy grab that cup. It's
Good for you.
Good stuff.
So listen, yeah, we can take the conversation in different ways. So if you got questions you want to touch on, this is a presentation that we originally put together last month in July, and I know as we get closer to the election, things seem to change on a weekly basis. So if there's certain topics that come up that you're curious about, please utilize the chat. We can take the conversation in a number of different ways, but this presentation, hopefully what my goal here is to talk a little bit about the economy, tell you some things that are happening underneath the surface, a couple of that you're probably not aware of that are explaining why the economy has been so strong over the last couple of years in the face of higher interest rates and whatnot. And then we'll shift over to financial markets, and we'll kind of talk about some of these big trends that have been in place for really the last 15 years or so. And then we'll finally end with a little bit of a conversation about the outlook going forward. And sort of the gist there is what's gotten us here over the last 10 years is probably not what's going to carry the load 10 years going forward. So we're going to need to think about how we adapt. And it can't just be, let's do the same thing we did over the last 10 years. So let's start with this. Now, I'm going to get into a bunch of charts and graphs and data and whatnot. And then for those of you that maybe get lost in all the data, this guy is probably the best visual representation of the U.S. economy. And we've had this theme of still going for several quarters now, because it seems like no matter what gets thrown at the economy, it just keeps marching along. You go back to just last year, we had 3 of the 5 largest bank failures in U.S. history. And the economy just shrugged it off and kept on marching higher. But the presentation was still going, but slowing, we got to recognize that we're also slowing down. So when you think about the economy, think about this Energizer bunny. He's going longer than anybody would have expected, but he is still running on batteries, right? He's not plugged into the wall. So we got to be sensitive to the pace at which this guy is marching across the screen here. So let's talk about the economy at a high level. So on the left-hand side of the chart here is your standard GDP, right? Most people, read GDP as real GDP, which is the blue line on the left-hand side. And let me get a little laser pointer here so we can be a little more precise. Okay, so blue line is real GDP. Back in 2022, we actually had 2 quarters of negative GDP, which a lot of people think, is kind of shorthand for a recession. We didn't have a recession, so that was certainly a positive. But importantly, this gray line here is is nominal GDP. So strip out inflation, ignore that. The reason why we focus more on nominal GDP is because that's what drives corporate revenues and corporate profits, right? It also drives future tax revenue for the government, right? We don't get to deduct our taxes based on inflation, unfortunately, right? They're going to tax us on the whole thing. Importantly, on this graph on the left, if you went back to 2019, right before the pandemic, the US economy today is 30% larger in nominal terms. It's 30% larger than it was in 2019. So you take this huge collapse in economic activity as we closed the economy, we came roaring back. And we've leveled out sort of at a level of growth that is higher than where we were before the pandemic, right? So we've got this sort of higher level of growth. And then if we go over on the right-hand side, we have job growth, right? So this is every month, first Friday of every month, the Department of Labor comes out with how many jobs were created. We're down to 114,000 jobs created. We were at an area where there was way too much growth, right? We were adding jobs at 500,000 jobs a month. And the Federal Reserve, obviously worried about inflation, was trying to slow the economy down, and they've done that. But now we're getting to a level of job growth that's a little more, we don't want it to slow too much further. So we're keeping track of jobs, but thus far, labor market has been extremely resilient. But the pace of slowing needs to start leveling off. Or else we start to get into an area that's maybe a little more concerning. So here's the 2 sort of driving forces from policymakers that are working behind the scenes. So on the left-hand side, we have the federal funds rate. So obviously we had a huge bout of inflation coming out of the pandemic. Federal Reserve raised interest rates basically from 0 up to 5.25% to 5.5%, where we've sat for about a year now. So they're trying to pump the brakes on the economy. At the same time, you've got Congress and the fiscal spending. They're running a deficit that's equivalent to 6% of GDP. Now, if you exclude this period here during the pandemic where we just wrote checks, right? We did PPP loans. We were basically just sending money out. A 6% deficit is the largest deficit we've seen outside of a recession, really in US history, right? Outside of, let's say, World War II. So it's very unusual to have the economy or the federal government supporting the economy in such a way. So on one hand, you've got the Federal Reserve trying to, pump the brakes. On the other hand, you've got the fiscal impulse with Congress and the administration wanting to spend more. Now, importantly, what we're spending on here on the right-hand side is quite important. So over the last couple of years, the administration has rolled out the CHIPS Act, the Inflation Reduction Act, and the Infrastructure Act, trying to get spending that is positive for economic growth and really to address some of the supply chain inefficiencies that we've had, that the pandemic revealed. And so a lot of that money is being spent in quite productive ways. We'll have to see if we get a return on that investment, but we're going to talk about that a little bit more. So a little bit on inflation. So what was the big problem over the last, few years? Inflation got up to, 9%. So on the left-hand side here is headline CPI. But inflation obviously has come down a long ways. We're currently at, 3% inflation. And if we look at just the last 3 months, so inflation is always measured year over year. But if we look at just the last 3 months and annualize it, right, gives you sort of an early leading indicator as to where year over year inflation is going, we're down here at 1.1%. Now, the Federal Reserve is their mandate is 2% inflation. And they're now at the point where they're confident that we're going to get to 2%. And so Jay Powell, on Friday, all but said we're cutting rates in September, which will be a positive for the economy. The question is just, can that extra positive stimulus from lower interest rates help slow the decline in the labor market?
So
The one other aspect. Oh, I'm sorry. Go ahead.
yeah, no, you're good. You're good. You get rolling. So, are we seeing it like what are the credit marks showing us? Are we seeing any indicators in where the credit markets are thinking Powell will do? And then kind of a two-parter, if I may, if we see a half point, which I know there's been some dialogue around that. I don't know how high of a predictor the credit markets are showing of a half point. But is there any indications in terms of how much that'll correlate to mortgage rates and the stimulus that may come in the housing market and housing affordability in that area?
Yeah. So there's really two aspects there. So one, the Federal Reserve adjusts short-term interest rates.
Right.
They're less so targeting, what the 10-year Treasury yield is, which is what mortgage rates, what your 30-year mortgage rate is priced off of. So this is actually a good thing you bring this up. We had a conversation about this just yesterday. There's really two outcomes that can happen going forward here. And I wish I had a graph to show this, but when the Federal Reserve starts lowering interest rates, we get kind of one of two different outcomes. Oftentimes we do get a recession, right? They're lowering interest rates because the economy is weakening. And in that environment, you get lower long-term interest rates. So the 10-year yield goes down, your mortgage rates go down. But there are also a number of instances where the Federal Reserve has lowered interest rates and it's actually stimulated economic growth. And so therefore the long-term interest rates actually go up, right? And so that would be a headwind to, mortgages and housing activity. And so ironically, the answer to, what's going to happen with mortgage rates isn't really what the Fed's going to do. It's what's the outlook for growth in the economy. And does the labor market continue to weaken? Then you're going to see interest rates go lower, mortgage rates come down. The challenging part with that is that it likely requires, it likely means also job losses in the economy, which we haven't seen. So it's a little bit of a double-edged sword. We want to get enough slowing so that mortgage rates can come down, and we're seeing them come down now. Mortgage rates were at 8%. We're just above 6 3/4 at the moment on a national average. So we're moving in the right direction. But I don't think it's reasonable to think that we're going to get back down to 4 without some pain in the economy.
Yeah, we know how we got to 4, and I don't think, the people on this call have money in the equity markets. We didn't like what the equity markets did for us to get to 4% mortgages, and I don't think any of us want to go to that again.
Right. So we're trying to, and Powell is trying to thread the needle of slowing the economy down to get rates down enough, but make sure that we don't, make the wheels fall off the wagon. So it's a challenging little exercise, and so far they've done a phenomenal job, right? We've gotten inflation down to 3%. We're on our way to 2%. The market's at 1% from an all-time high at the moment. Like, we're holding in there well. So the question now is just, okay, can we stick the landing? And that's a big question mark.
Yeah, I hope we have a Carrie Shrug Olympic moment, right? The female Olympus who injured her leg. I hope we have one of those unexpected sticks on the vault, right? That'd be for all of us.
That's what we're looking for. That's what we're positioned for. The market's telling you that's the likely outcome. So one last thing on this, just to point out, on the right-hand side is average hourly earnings. So the nice thing right now, for the positive thing for the U.S. economy, is average hourly earnings. So our wage growth for everybody is going up more than inflation, right? So in real terms, we have more disposable income to buy goods and services and whatnot. It's not all just being eaten away by inflation. So that's a real positive. Here's one thing Cal, that I think is important. And I don't see people talk about this in financial media and whatnot, but it's curious because it's so bright as day. A lot of people during the pandemic went out and tried to estimate, okay, how much money went out into the economy and then how much was spent. And so there was this concept of excess savings that economists would talk about. And the fear was that excess savings was getting spent and the consumer was going to be tapped out, if you will, right? They're not going to be able to keep up their level of spending. However, the graph on the left-hand side tells a little different story. So this is comes from the Federal Reserve. So they supervise all the commercial banks. And so they know what all their balance sheets look like. And so this is the aggregate balance of all of our checking accounts, of every checking account in every commercial bank in the United States. So if you go back to before COVID, we were hovering around $1 trillion or so in aggregate checking account balances, right? We didn't go put it in a money market fund. It wasn't going into stocks. It wasn't going anywhere else. And so during the pandemic, we went from $1 trillion to almost $5 trillion in money sitting in checking accounts. And we're hovering now at about $4.5 trillion. So there's an enormous amount of money out there in the economy. Now we don't know who holds it. Okay. But there's an enormous amount of money just sitting in people's checking accounts, which usually are used for, your everyday spending, right? If it was something, hey, I don't need this money for 6 months, you'd expect that money go to a money market fund. Maybe I'll invest it for a little while. But I think this has provided some resiliency to the consumer, even though interest rates have gone up. So, if you go buy a car today, interest rates are higher, so your car payment's more. Inflation obviously has been a real thorn in everybody's side, but in aggregate, there's a lot more money out there. Okay. But it's not very well, it potentially is not very well distributed. So the graph on the right here is the delinquency rate for all loans at all commercial banks. So the blue line is all loans. So think of mortgages, commercial loans, credit cards, everything's all lumped together. And delinquencies are at extremely low levels. This is looking at over the last 10 years. However, if we pull out just credit cards, credit card delinquencies are at the highest level they've been in 10 years, right? Nowhere near where we were during 2008, but it's a disturbing trend, right? How could we have all this money out here in the economy, yet delinquencies on credit cards are at the highest they've been in 10 years? So it prompted us to do a little study. And what we did is we looked at, we wanted to figure out, okay, is it all that money that's out there? Is it just held with the top 1%? Or is it well distributed? Okay. And so first of all, let's start with the graph on the left. This is total net wealth in the United States. So this is everybody's home, your brokerage account, your 401k, your IRA, all that minus all of your liabilities. Okay. We're up to $161 trillion, which is kind of an unfathomable number. It's kind of tough to wrap your head around it. But the important part of this is the graph on the right-hand side. And so there's a couple of different lines here, and let me help wrap your head around it. So let's start with this light gray line. This is the total wealth of the top 1% divided by the wealth of the bottom 50%. Okay. So this peak up here back in 2010, 2011, the top 1% surprisingly had 78 times the amount of wealth as the bottom 50%, right? Massive levels of inequality, right? The top 1% has almost 80 times the wealth as the bottom 50%. However, over the last, 10 years or so, that ratio has fallen all the way down here to 12 times. Okay. So depending on what you're thinking of in terms of inequality, is that right or wrong? It's certainly better than where we were. Okay. And what's important here is actually how we got down to this 12 times from 80 times. Is the blue line here is the wealth of the bottom 50%. Okay. So starting in 2009, the bottom 50% have seen their wealth grow almost 800%, while the top 1% has grown 186%. So it's been a phenomenal run for the folks at the bottom, 50% of net wealth. And a lot of that gain came since COVID, right? So here's the kind of where COVID shot us up. And a lot of this is people that were in high cost cities, renting, maybe sharing an apartment with somebody, could work from home. They could move out to, another state, maybe it's a lower tax state, lower cost of living, buy a home, and participate in, what was a phenomenal run in home prices, over the last several years. Anyway, the gist here is the median consumer, the average person out there, which is really part of this blue group, is in a much better shape, right? Sure, there are some people that are struggling because credit card delinquencies are high, but it's not the average person out there, which is what we really want to measure when we're talking about the economy. Now, I want to switch gears to one other tailwind that's been at our backs for a while, but might be fading, and that is construction spending. So I know I started out at the beginning talking about the deficit, and some of that deficit is going to very productive spending in the CHIPS Act and the Inflation Reduction Act, and basically what we're doing is we're giving out grants in many cases to large corporations for them to rebuild their supply chains here in the U.S. So Intel is a big, has been a big beneficiary. They got billions of dollars in grants from the government to, set up manufacturing plants here. The interesting thing is sort of the timing of how this all happened. So just to orient everybody here, so the blue line is residential construction spending, and then the gray line is non-residential construction spending. So residential is, hey, how many homes are we building? How many condos, apartments, and whatnot? And it's very sensitive to changes in interest rates. So as the Federal Reserve raised interest rates in 2022, residential construction spending fell off a cliff, right? It slowed down substantially. But at the same time, we had these various programs from the federal government incentivizing non-residential construction spending, which skyrocketed, right? And it happened to offset the slowdown in construction spending. So if you look at non-residential construction spending, if you go back to November of 2023, last year, it was growing at 16%, right? I mean, we were increasing the construction activity at a staggering rate. At the same time, home construction was really slow. The point is now, though, both of these are starting to level off, right? We had this initial surge of all these grants that went out, and it seems like the pace is slowing down. And this has been a big tailwind for the economy, but it's starting to slow down a bit. And we'll see. It could just be a lull in some of the grants that have gone out. But one of the things that's noteworthy is if we look down here, we also include construction payrolls, because while we care about how much money is being spent, the key to the U.S. economy is the labor market. And so far, construction payrolls have been solid, right? We're growing at 3% or so. It's holding steady. This line that's got all some of the red here is if we take the last 3 months and annualize it. So construction payrolls are holding in, and that's positive. But if you look down here, the number of housing units under construction is starting to slow significantly. And so I wanted to share a little bit about that. So total units under construction. So this is all of your single family homes being built, apartment complexes, condos, whatnot. You lump them all together, you get this graph on the left-hand side. And so we're up here at about 1.6 million units under construction, which is basically a record, except for where we were 6 months ago. So construction activity has been huge. And if you look back, I think most people on this call would probably remember, you go back to 2005, we had a huge surge in building, which was sort of the lead up to the housing downturn, and then ultimately the financial crisis and all that. We're building more homes today than we were back then. Okay. Now, part of that is population growth. And so this is just a measure of supply, not necessarily demand. But I think what's interesting is actually the composition of the types of homes that are being built. So on the right-hand side, we actually break it out by single family homes. So you go back to that 2005, we were building nearly 1 million homes. We're under construction at any given time. We're now down under 700,000, right? Called 680,000 units. So it's not single family homes that are being built at an alarming rate. It's actually multifamily, right? So it's apartments and condos and whatnot. So part of this is a leftover sort of after effect of, if you go back to Trump's Tax Cuts and Jobs Act, part of that was he created this part of the tax code that created opportunity zones. And maybe you've heard of these things where it's what are they called? A qualified opportunity zone. You could take appreciated stock, right? So if you had invested in the financial markets, you had big gains, you could take those gains, not pay taxes on them, and put them into a real estate fund that would go in and revitalize these opportunity zones. And what most of these builders did is they went and built sort of mixed use, apartments on, apartment towers with resident or with retail space on the bottom. And what we ended up with is this huge surge in multifamily construction. So it's been a great tailwind for economic activity thus far, but we're starting to come down the other side of it. Obviously, with higher interest rates, construction activity is expected to slow. What we're looking at it through the lens of is, how does this affect the labor market? Because there's about 8 million people that are involved in construction, right? Construction jobs, and they're not all building homes, but they might be involved in building the sewers or the roads or the other infrastructure that's involved in all of this construction. And it's an important and highly cyclical part of the economy. So far, it's doing good, but this is one of those things that we're keeping an eye on because it could change.
What about housing inventory? I know that for quite some time, almost got to the extent that it wasn't even worth looking at the data, that available housing in terms of units, it was sitting at extraordinarily low levels, whether that was for purchase for rent, right? That both were operating at low levels. Is that still the case? And if so, how does that affect, I think one of the concerns that I've heard a lot is, like, how are my kids going to be able to afford a home and purchase a home, and or just home affordability for the 30 and under crowd, in terms of a long-term economic headwind? Is that a real thing?
Well, so it's a good question. So there's two parts. I mean, one, break up the supply into two parts. There's an unbelievable number of homes that have got a mortgage rate that's sub 4%. I think
Right.
I looked at it yesterday. I believe it's 60% of all mortgages are below 4%. Don't quote me on that, but it's right in that ballpark. So there's an awful lot of people that are simply the greatest asset of their home is almost not their home. It's the mortgage they've got, right?
Yeah.
And so those folks are going to try and hold on no matter what. Now, this isn't gonna hold out forever. People move, people change jobs, people get married, people get divorced. Like, there are things that happen that we're gonna naturally see those mortgages start to taper off, and we're already seeing it, right? So there is a slight downtick in the number of mortgages that are in those extremely low rates. But at the same time, you've also got new home construction is there is growing inventory for new home construction. So it's kind of a tale of two different sides. The new construction is trying to meet the demand that current supply, existing home supply can't meet because nobody wants to sell. But these things don't continue forever. Something's going to change. We'll get either wages are going to go up substantially, home prices will level off. Maybe mortgage rates go back down. I mean, these sort of dislocations, I don't think are going to last forever. So if you're somebody in your late 20s, early 30s, don't have the mindset of like, oh, I'm never going to be able to, afford a home. These things will change. So this is I think sort of a temporary aftershock or after effect of one, obviously the pandemic, super low interest rates. And then two, we've got this, excess construction that's happening out there that should help stabilize the market, right? So you're going to get increased supply out there, which should slow down home price appreciation. And then hopefully along the way, we have increased wage growth that we see that makes housing affordability in a better place.
Thanks.
Okay, so one last thing on the economy here is the national debt, and I know everybody, it's a hot button issue. Doesn't sound like either candidate is really taking the situation seriously. So the deficit's going to continue to run. And we've had some instances where clients send us a graph that kind of looks something like what we see on the left. This is the dollar amount, this is the interest expense of the US government, right? How much are we spending on on debt. And, we already are spending more on our interest expense than we are on defense. The only thing we're not spending, outspending on is on Social Security. So it's a not a good trend, but the graph on the left-hand side doesn't tell the whole story. Remember, I told you 5 years ago, the economy was 30% smaller, and the nominal size of the economy determines what our tax revenues are, our ability to pay our debts. It has to do with corporate profits as well, which we'll talk about in a minute. But the graph on the right-hand side is our interest expense relative to GDP. Okay, so if you go back to the late 80s when Volcker was, or I'm sorry, early 80s when Volcker was raising interest rates to kind of hammer inflation, we were spending more back then than we are today in terms of interest relative to GDP. So the trajectory is not good, but at a level like we've been here before, it's manageable. We can get through this either through a combination of potentially higher taxes. I know that Harris has put together recently rolled out a proposal to create some new tax policy. We could talk about that in the Q&A maybe, but the important thing is the graph on the right is the one that we should worry about. We're not in unprecedented territory. It's manageable. It's not going to get fixed during this election cycle. But hopefully once the election is behind us, folks in Congress and in the administration can start to look at how we start to address this slope. So that was the economy. How am I doing time-wise? And I apologize, we're already at 30 minutes in.
You're good. You're cooking on high heat. I think you're doing well.
Okay. So now let's switch gears to financial markets. Okay. And I go back to our Energizer Bunny. So if we had all the financial markets, kind of out there, in a foot race, this little Energizer Bunny would be the US financial markets. So US stocks. And he's marching out in front of everybody else, turning around, looking back, saying like, hey, is anybody else going to catch me? It has been a phenomenal run for US based investors that have obviously, we all have a significant portion of our net worth in, US based equities. And so this Energizer Bunny is a good, I think a good depiction of that. To put some numbers behind it. So now this is a little dated because it's only back through April, but the story hasn't changed. So what we're looking at on this graph is the last 10 years, and we're looking at 5 of the most common equity asset classes that investors have in their portfolios. So you start with the Russell 1000 growth. This is your large cap growth stocks, right? It's gonna be your Amazon, your Nvidia, Apple, Microsoft, all those. Over the last 10 years, they're up 325%. That's a compound annual growth rate of 15.6, so phenomenal run. The distant second one down here in sort of the mid blue here is US large cap value, 126%, followed closely by small caps. So the Russell 2000 up here at about 100%. And then distant, down here you get down to international developed. So think Germany, Japan, everything that's, outside of the US, but not an emerging market. And then way down here at the bottom, you get emerging markets. So we've had this huge dispersion of returns where basically if you've owned US large cap growth stocks, you've done phenomenally well. But if you owned, a lot of international or emerging markets, you have probably lagged some. Now, some people say, gosh, US equity markets, is this a bubble? Is it just it's the Magnificent Seven, those 5 stocks or whatever. Don't think that's the case. Importantly, during any economic cycle, every economic cycle has some asset class that wildly outperforms everything else, right? So this is not some, once in 100-year kind of thing. This is totally normal, and it happens all the time. The thing to be aware of, though, is every economic cycle has a different asset class that is the star performer. Okay, so the last 10 years, it's been US large cap growth. If we take the same 5 asset classes and we look at the last sort of full cycle, we go back to the 10-year period leading up to 2007. Now, admittedly, this straddles sort of 2 different economic cycles. In the early 2000s, it was a fairly short economic cycle, right? From 2002 to 2007. This is 2007, way off on the right. Same 5 equity asset classes, 10-year returns. You'll notice that large cap growth was the worst performer. what is the worst performer today was emerging markets. It was the star performer, right? And it was head and shoulders above everything else. The point here is that leadership changes from one cycle to the next, right? And while, we love we love US large cap growth stocks, we own, most of them. We just have to be cognizant. We got to own them kind of eyes wide open that that sort of leadership, while it's common, it's very uncommon for the same asset to continue that outperformance from one cycle to the next. Now, let me show you this graph. Now, this is maybe a little bit of a challenge to orient with, but let me break it down for you here. So what we're looking at is, forget about all those international stocks or small caps and those others. This is just looking at the relationship of large cap growth stocks, right? So your Microsofts, Apples, all those, versus large cap value stocks. Think Berkshire Hathaway, JP Morgan, right? Coca-Cola. So when this line is going down, right? This is the return of growth stocks minus value stocks. So if this line is going down, it's value stocks are outperforming, okay? And this is the 1980s, okay? Then we get into the 1990s and it was growth stocks, right? This was the dot-com, what we now call the dot-com bubble, right? And then we get to value stocks outperforming again in the early 2000s. And then we've been in this huge run where growth has outperformed. Now, importantly, we reset the relationship of this ratio here back to zero at the low of the unemployment rate. And that's what this gray shaded area in the back is. Because what typically happens is we get close to the end of an economic cycle. What has been working for that entire cycle gets overinvested. Too many people own those stocks. And then things start to shift. The economy starts to weaken. People start to get fearful. And as they start selling stocks, they end up, because they own so much of them, they sell what's performed the best, right? They sell what's gone up the most. And we end up getting this big leadership change. The other thing that happens is that we tend to get fiscal policy response from the government. And that fiscal response does not send out stimulus evenly across the economy. So today, the CHIPS Act, the Inflation Reduction Act, those are all largely benefiting large cap growth stocks, right? The CHIPS Act is specifically designed to give semiconductor companies money to build their infrastructure here in the US. Well, those are all growth stocks by and large, right? But the important thing here is just be aware that what's gotten us here over the last 10 or 15 years is going to change. It's not going to be the same leadership going forward. Not that it's going to change next week or next month, or it could be 6 months from now, it could be 2 years from now. But we want to go into it eyes wide open, knowing that there's going to be a leadership change. So we don't get so anchored to, I own Amazon, I'm never going to sell it, right? That's the mindset we want to try and avoid, because there's always going to be a time to sell something. A couple slides here real quickly on just the concentration in equity markets. So some people have gotten concerned, these top 5 stocks make up so much of the US equity market. This graph is a little dated. We actually got up to about 28% here recently, where top 5 stocks, all technology related names. So Microsoft, Apple, Google, Amazon, and Nvidia made up about 28% of the S&P 500. Some folks, would get concerned that, concentration is bad. We get one problem with one of these stocks. It's going to be, it's going to be hazardous for the stock market going forward. So if we look at other developed market economies around the world, or developed markets around the world, you'll notice this is showing the largest stock, the top 3 and the top 10 stocks, and the percent that those stocks make up of the market cap of their country's stock market. The US is down here, right? Still kind of, lower end. We've got a lot of other financial markets that have got higher levels of concentration, and it doesn't cause a problem there. So we don't think it's a concern. Certainly if we saw, earnings weakness from those companies, or, something, sure, it's going to have an outsized impact, but it's not a recipe for, the market's got to go down. Not at all. I don't think that's a good way to think about it. Importantly, these top 5 stocks, we're going to find out a little bit more about Nvidia after the close today. But if we look at their earnings on the left-hand side, this is their earnings over the last 12 months. They make up 18% of the S&P 500 earnings, right? So yes, they are large. They also make up a big chunk of earnings, and they're growing their earnings. They're expected to grow over the next 12 months expected to grow earnings at 45%, right? So massive earnings growth. And if you look at this and you say, gosh, well, look at NVIDIA, it's all NVIDIA, right? Between the left and right-hand side. If we exclude NVIDIA, the other four are still growing earnings at 17%. So yes, they're big. Sorry, my little chat thing, I should have closed that. Yes, they're large, but they do have fundamental reasons for being so large. They are growing at an astonishing clip. And we'll see what what NVIDIA does after the close today. Hopefully, hopefully that continues. Importantly, if we step back from just those five stocks, corporate earnings, so we look at expectations for earnings for the full year, 2024 versus in 2025, earnings expectations are positive and they're being revised higher. So left-hand side is looking at, each year, but we also go as far as tracking analyst expectations for next year and how they're adjusting. So there's, hundreds of analysts that are following all of these stocks, and they're constantly making adjustments to their earnings estimates. In this case, we're looking at 2025, and we look at this on a weekly basis, and they're being revised higher, right? Some sectors are going a little lower, some are going up, but if you aggregate them all together, analysts are continuing to get more optimistic on corporate earnings going forward. So I think that's a positive backdrop for equities overall. But now let's talk about valuations a little bit, because we've talked about a lot of good things that are happening. The graph on the left-hand side is just showing the 10-year annualized return for the S&P 500. So we just take any given day, look backwards, what was the 10-year run? Currently, we're at about 10.4% is where we are currently. That's almost double the 10-year average, or the average, I should say, 10-year return going back to 1900. So we've had a phenomenal run. Keep in mind, this is just price returns only, right? So if it was with dividends, we'd be closer to 12.5%. Now, importantly, though, we've gotten to a point where valuations have gotten quite stretched. And there's a lot of different ways of measuring valuations. And so we use one on the right-hand side. But now this huge mess of dots, let me just help kind of explain here. Every one of these dots that you see here, we're looking at the 10-year forward returns this time. So all these dots over here that make up this line on the left are over here on the right. But this time on the x-axis, we put the what's known as the CAPE ratio, or a cyclically adjusted PE ratio, okay? What that means is we're going to take the current price of a stock or the overall market. We're going to divide it by the average of the last 10 years of earnings. And the reason you do that is you take out a lot of the cyclicality of corporate earnings, because earnings do, go up and down, rise and fall. And we're trying to strip all that out. And if we do that, we end up here where this blue dot is, okay? Now, the other instances where we were this high, we're up at 33 times, earnings. This group of dots over here was the dot-com bubble, so 2000s, right? We got way up here to 45 times or so. And the other unfortunate period was back here in 1929. Was this group down here? Now, no, we don't think that we're in a stock market bubble. It's not the same thing. And no, we certainly don't think we're going towards a Great Depression. But you go up here, there are periods where, hey, maybe returns are more like 5% over the next 10 years. That's quite possible. And who knows, it could be better. But history would suggest that the fact that we've done 10% returns over the last 10 years, we're very unlikely to do 10% again going forward. Maybe we're going to get something more like the long-term average of 5.4%. And keep in mind, all of the returns in equity markets over the last 10 years have all been US equities. Emerging markets have been left behind, right? International stocks have been left behind. And we think there's an opportunity to be smart about how we diversify away from US equities, especially as we get close to the end of this economic cycle. We're hopeful that we're going to have the proverbial soft landing and things are going to go back. The economy is going to reaccelerate, but we need to be on our toes. And I think this is a time where you really need to be agile with how you're managing portfolios. So this is just our outlook, our sort of playbook for how we're thinking about this. So we've been in an environment on the left-hand side here where the Federal Reserve has raised interest rates. Even if they cut 50 basis points or 100 basis points, keep in mind, they raised rates 500%, or I'm sorry, 500 basis points, 5%. If they cut a couple times, that probably isn't going to do it. We need probably 100, 200 basis points of cuts to get back to something that's going to stimulate growth. But in that environment, remember, those large cap tech names, they can grow earnings, whether GDP growth is 2%, 1%, 4%, they're going to continue to grow, right? So we want to own technology, communication services, some of these AI beneficiary names, and importantly, quality growth. You want to own high quality companies. You don't want, some, small startup that's only been around for 5 years. We want to own the big boys, right? Now, at some point, we're going to get to a cycle peak and the economy is going to roll over. It's not a matter of if, it's a matter of when. It always happens. It's no big deal. We just got to manage it. However, in our study, going back and looking at prior peaks, you tend to get weakness in both the labor market and credit markets at the same time as sort of the leading indicator that you're going to have weakness in the overall economy. Going back to 2022, I talked about that there's 2 quarters of GDP, negative GDP growth. The labor market was extremely strong, so we didn't get a recession. Now the labor market is growing at a much more modest pace, and so if we get weakness in labor and credit, we think that's probably the time to start looking about how do you manage out of some of these positions, start to think about getting a little bit more defensive, but more importantly, thinking about what's going to be the new leadership. It's not going to be, most likely, it's not going to be U.S. large cap growth. We want to look at those areas of the market that have been kind of left behind, and where the new leadership will be. And I don't think that you're going to see a major significant downturn when we get a recession. Don't think it's got to be 2008. Like that's not, that was an anomaly. That's not the normal kind of recession. Remember, going back to how much money is out there in the economy, there's a lot of pent up, or I should say a lot of excess savings, that if there's some weakness in the economy, and things start to get cheaper, there's a lot of money that can be deployed that should support the economy. So we're focusing on how we navigate this transition, and we're trying to be very thoughtful about it, expecting that the next 10 years are going to look very different than the last 10. And that's not necessarily a bad thing. It's normal. It happens during every cycle. We just, as investors, need to just not get anchored to what worked over the last 10 years and keep going back to the same playbook. We got to be open to shifting to other areas, as those opportunities present themselves. Kyle, with that.
It's awesome. Phil, I appreciate it. You either are the greatest presenter we've ever had, thorough, or people may just not have they're having that afternoon, they need a Red Bull or a coffee, because I normally would have some questions in here. So I want to pause from my end. Is the Fed still interacting quantitative tightening? Are they not?
They are, certainly.
Okay.
Mm-hmm.
Okay. So, and for those who aren't familiar, during 2020, the Federal Reserve purchased an enormous amount of bonds. The numbers, one of those incomprehensible amount of numbers, even if I memorized it, would mean nothing to any of us. But one of the questions I have is, as we look to potentially cut interest rates, is there been any conversation in the Fed to slow that process, at some level? And if so, what effects might that have to the economy?
So there surprisingly, there's been very little talk about the balance sheet. So in all of the press conferences that Jay Powell has done over the last 6 months, as they're kind of getting ready to cut interest rates, they seemed very intent on avoiding talking about the balance sheet.
Yeah, I hadn't heard anything either, Phil. I wondered if, yeah.
Well, I think if you think about going back to this, yes, they bought an enormous amount of treasury bonds and mortgages during the pandemic. I think they would love to get to a point where that can all just go away, right? They want to just get rid of it all, but they don't want to do it in a way that disrupts financial markets. And so currently they've got it where they're reducing by, I believe it's $120 billion a month. And so they are weaning that off, and they're doing it kind of quietly in the background. And I think that's the ideal thing that they're trying to do. And they're trying to separate that decision from their everyday monetary policy. They'd love to get back to just, let's raise interest rates and lower interest rates. Let's use the balance sheet and let's buy, $5 trillion worth of treasury bonds. I think they'd like to get away from that policy. And I think that's why they're not talking about it. They'd love to just continue to let it wind down.
So do you think it's a move away from that policy, or do you think that quantitative easing and direct loans from the Treasury, like we saw in 23, do you think that's something that's here to stay during significant market and economic disruption? Because they've proven to be meaningfully effective in terms of mitigating substantial economic risk.
Oh, so 100%. I'd say not 2023 was the bank term, funding facility. That was for Silicon Valley Bank and the regional banks. What I think most people don't understand, and says you could do a whole conversation on this. If you go back to 2020, the Federal Reserve enacted some extraordinary policies during that time period. And keep in mind, we were all looking for N95 masks and figuring out, do we need to, how many times do I need to wash my groceries? And, so, but the Federal Reserve went out and they enacted about 13 different credit facilities that they literally backstopped every form of debt in the country. So your auto loan, if you defaulted on your auto loan, your lender wasn't gonna be on the hook for it. They had a credit facility for it. They had one for credit cards. They had one for mortgage. They had something for everything, all the way down to nonprofit organizations. And yes, those policies were extremely effective because they actually didn't even have to really use them. And so I think if and when we get into a trouble spot and we do, need support, I think the Federal Reserve is better armed today than they probably ever have been to address any sort of downturn. But I don't know that it's going to be that, hey, let's buy $5 trillion, because they were able to roll out these programs. Just the fact that they were willing to put them out there, they never had to use them. So they didn't have to spend $1, and the market stabilized and things got better.
It was unbelievable. And did I misunderstood what the Treasury did in 23? Did they not enact something quite similar to what they did in 08 and 09 with MBS? Willing to buy MBSs in 08 and 09, that they were buying treasuries, underwater treasuries from banks in 23, like a very similar strategy in 23, just a different flavor. And for
It's similar.
similar
Yeah.
strategy, right?
Yeah, so that's what they call it. It's the Bank Term Funding Program, which
Right.
is now they've stopped taking new. But basically, what they allowed banks to do is, if they bought a mortgage bond, let's say at par, right at 100, interest rates went up, and that bond was now trading at 70 cents on the dollar, trading at 70. Obviously, the bank's got a $30 loss there, and of course, it's not $30. We're talking about hundreds of billions of dollars in some cases. This program from the Treasury would allow that bank to take that bond that's trading at 70, they hand it over to the Treasury and the Fed, and the Fed would give them a loan based on the full par value of that bond, right, or of that mortgage. And so it gave banks some wiggle room to, kind of shield themselves from some of these losses, help fix their capital positions, and it's worked, phenomenally well.
Blendedly. And I think the misnomer is, well, the taxpayer bailed out the banks, whereas those two organizations can hold that position to maturity, right? And as a result, they come back to fair market value, original fair market value. And so time makes up the loss. It's not a taxpayer bailout. It's these organizations have a different time and funding requirements than banks do.
100%. 100%. Yeah. So the federal government, is the one that enacts, sort of the tax policy, and hey, are taxpayers on the hook for this? You go back to 2008, it was TARP was the big program that they rolled out. The Federal Reserve gets to kind of play outside of that realm, and they have the ability, in conjunction with the Treasury, to create these facilities to tackle sort of these specific risks as they come up. And in an odd way, it's really fortunate that over the last several years they've had to go in and get creative with some of these things, because I think it gives them a better toolbox going forward, that they say, hey, these are tried and true measures that we can use in the event we get a downturn, to help stabilize things. So I think it's a positive. But
I agree with you. I think it's under indexed. I think those two tools, those two big kind of tools of variation differences that in 08 and 09 and 2020 and 2023, when these really disruptive events unfolded, they seem to be effective. There was one question that came in when we look at emerging market equities and the fact that they're trailing really everyone else. what are the valuations to say? Does it say that, if I've got a 401k and I'm looking at my allocation, is this a wise time to think about taking, a more, aggressive or above, standard allocation to emerging markets now, or do you think that time's still in the future? Not
Um,
spot there.
yeah, so no, it's a good question. And I think I'm going to give you kind of a two-part answer, and it depends on what your time horizon is. Not for, when you're retiring and, when you need the money, but, if you're somebody who, hey, I want to set my 401k, I don't want to think about it for 3 years. Like, let me just set it and forget it and just, okay, you might have I can make a case for, yeah, starting to over index a little bit to emerging markets. If you're somebody who, hey, I go in and look at it every quarter, and, I kind of keep track of how I'm doing relative to the market, and you're kind of, more hands-on, I'd say you could wait a little bit. Well, I'm very confident that, hey, if you say, I want to look at the two assets and what's going to be better over the next 10 years, I'd say probably good money, emerging markets is going to be better. I just don't know if it's going to be the next 12 months, right? The next 12 months, especially if we get sort of a soft landing scenario in the US economy, you could see US large cap, growth, the same stocks perform well again and continue to do well. But at some point, we're going to get a leadership change. History says, like, hey, these things don't go on for 25 years. So we're going to get a leadership change, and usually buying a basket of those things that have underperformed, you're going to catch whatever is next cycle's winner. So kind of, it depends on your time horizon. We're looking at this stuff every day. So we're still in large cap growth. We're still playing what's working today, but we've got an eye to, okay, we know it's likely to work out in the future, and we're going to try and manage that transition. If you don't want to work that hard on it, you don't want to think about all that, and you're okay with not outperforming the S&P over the next 6 to 12 months, start looking at those areas that have underperformed, things like emerging markets, international developed. And as long as you can close your eyes and not worry about, did NVIDIA beat earnings this afternoon? You're probably going to be much happier 10 years down the road.
Love it. Phil, let me just take a moment to thank you. Wonderful information, wonderful presentation. Always such a gift to have your team be part of our client community. I want to also just take a pause as we come to a charging close to yet another year. I just want to thank everybody that's on this call, for all those who are going to take time to watch this video in the future. It's truly been an honor to serve each and every one of you for the last almost 22 years as your advisor. Many of you that entire time. So I just want to thank you for the trust, the continued confidence. Phil, we thank you for being part of this community of service to these wonderful families that entrust us with their life's work. And certainly, if anyone has any follow-up questions on this, feel free to email us. Phil and his team are at my disposal, and be happy to send any additional questions you might think of the minute we end this video. So again, thank you, Phil, so much for your time, and we wish you a great rest of your day.
Thank you. Take care.
Thank you. Be well.